credit lines have been cut, the lifelines have been severed, and the largest precious metals dealers in the Western world are now operating on fumes. For years, we have talked about the physical silver shortage. We have tracked the drain from the COMEX vaults. We have monitored the premiums in Shanghai. We have watched the registered inventory collapse to levels not seen in decades. But through all of that, through all of the warning signs and flashing red lights, the dealers kept the shelves stocked. They kept the buy button active. They found a way to source metal and move it to the retail customer. We assumed they had infinite capacity. We assumed the supply chain, while stressed, was fundamentally intact. We were wrong. This morning, we received confirmation from multiple wholesale sources that the major bullion dealers in North America and Europe have hit their credit limits. They are maxed out. Their banking partners have frozen their credit facilities. And without credit, a dealer cannot buy inventory. Without inventory, they cannot sell to you. The machine has stopped. Ladies and gentlemen, this is Silverstorm Daily, and what I am about to share with you represents the most significant development in the precious metals market since the 2020 pandemic shortages. But this is not a temporary disruption caused by a supply chain hiccup. This is a structural breakdown caused by the banking system itself refusing to finance the silver trade. The very institutions that are supposed to facilitate commerce have pulled the plug, and the implications for the price of silver, for the availability of physical metal, and for your ability to protect your wealth are nothing short of catastrophic. Let me explain exactly what has happened and why it matters. When you go to a dealer website and click buy on a tube of silver eagles or a monster box of Canadian maple leafs, you probably assume that the dealer has that metal sitting in their vault waiting to ship to you. In some cases, that is true. But in most cases, the dealer operates on a just-in-time inventory model. They take your order, they use their credit line with their bank to purchase the metal from a wholesaler or directly from the mint, and they ship it to you when it arrives. This credit facility is the oxygen that keeps the dealer alive. Without it, they cannot breathe. They cannot transact. They are frozen in place. What we learned this morning is that the major banks that provide these credit lines to the bullion dealers have drastically reduced their exposure. In some cases, they have eliminated it entirely. We are hearing reports that credit facilities that were $50 million last month are now $20 million. Facilities that were $20 million are now $5 million. And some dealers have had their credit revoked completely, forcing them to operate on a cash-only basis. This might sound like a minor operational issue, but I need you to understand the mathematics of what this means for the market. A major dealer might sell $10 million worth of silver in a single day during a price spike. If their credit line has been cut to $5 million, they can only source half of what they need. They have two choices. Choice 1, they stop taking orders and put up a sold-out sign on their website. Choice 2, they raise their premiums so high that the demand drops to match their reduced capacity. Either way, the retail investor loses. Either you cannot buy at all, or you pay a massive premium for the privilege. This is not theoretical. This is happening right now. If you go to the major dealer websites today, you will notice something strange. The premiums on common bullion products have jumped by $2 to $3 per ounce in the last 72 hours. Silver eagles that were selling at $6 over spot last week are now selling at $9 over spot. Generic rounds that were at $2 over spot are now at $4 over spot. This premium expansion is not driven by mint production issues. The mints are running. This premium expansion is driven by dealer financing issues. The dealers are passing the cost of their credit crisis on to you. But here is the question that should be burning in your mind right now. Why? Why would the banks suddenly pull the credit lines from the bullion dealers? These are established businesses with decades of track records. They have collateral. They have cash flow. They are not high-risk ventures. The answer lies in the same systemic stress that we have been tracking for months. The banks are not cutting credit to the dealers because the dealers are risky. They're cutting credit because the banks themselves are in trouble. The banks need to preserve their own capital. They need to reduce their exposure to any asset class that is volatile, that is surging in price, and that represents a bet against the very fiat currency system that the banks depend on. Silver checks all three boxes. When a bank extends a $50 million credit line to a bullion dealer, they are effectively financing the purchase of an asset that competes with their core product, which is fiat currency and fiat-denominated financial instruments. As long as silver was sleepy, as long as it traded sideways between $20 and $25 for years, the banks were happy to facilitate the trade. It was a small, niche business that posed no threat. But silver is no longer sleepy. Silver has woken up. Silver has ripped from $25 to over $70 in a matter of months. The banks are looking at their exposure and realizing that they are financing a rebellion against themselves. They are funding the purchase of the one asset that exposes the fragility of their paper system. So they are pulling back. They are withdrawing their support. They are letting the bullion dealers twist in the wind. This is financial warfare, and the battlefield is the credit market. The banks cannot stop you from wanting to buy silver. They cannot outlaw the purchase of precious metals, at least not yet. But they can choke the supply chain by denying credit to the dealers who source the metal. They can create artificial scarcity, not by draining the vaults, but by draining the liquidity that allows the vaults to function. It is a brilliant and devious strategy, and it is working. The dealer community is in crisis mode. I've spoken with contacts at 3 major North American dealers in the last 24 hours, and the tone of those conversations was unlike anything I have heard before. These are people who have been in the business for 20 and 30 years. They have survived the 2008 financial crisis. They have survived the 2011 price spike and crash. They have survived the 2020 pandemic panic. But they have never seen anything like this. One contact told me, and I quote, "The banks have decided that we are the enemy. They do not want us to succeed. They do not want silver to succeed. And they are willing to sacrifice our business relationships to make that point." Another contact said, "We are operating day to day. We do not know if our credit line will be there tomorrow. We are having to turn away large orders because we cannot finance them. This is not sustainable." Let me walk you through the specific mechanics of how this credit freeze translates into market dysfunction. A wholesale silver bar, let us say a 1,000-ounce COMEX deliverable bar, currently costs approximately $77,000 at spot. A major dealer might need to purchase 100 of these bars to fulfill their weekly orders. That is $7.7 million in a single transaction. If their credit line has been cut from $50 million to $10 million, they can only purchase about 13 bars before they hit their limit. They're operating at 13% capacity. Now multiply this across every major dealer in the country. Multiply it across Europe, across Australia, across Canada. The entire Western retail distribution network is operating at a fraction of its normal capacity. This is why the premiums are exploding. This is why the wait times are extending. This is why the sold-out signs are appearing. The metal exists somewhere in the ground, in the refineries, in the vaults, but the financial infrastructure to move that metal from point A to point B has been deliberately crippled. And it gets worse. The credit freeze is not just affecting the dealers, it is affecting the refineries themselves. Refineries operate on even larger credit facilities. They purchase scrap metal, dory bars from mines, and industrial byproducts. They refine this material into pure silver bars and coins. They sell to the dealers and the mints. This entire process requires massive working capital. A single refinery might need a $200 million credit facility to operate smoothly. We are now hearing that the refineries are facing the same credit contraction as the dealers. Their banking partners are reducing exposure, demanding more collateral, and shortening the terms of the loans. This means the refineries are having to slow their production. They are having to be more selective about what material they process. They are having to prioritize the most profitable contracts and delay or cancel the rest. The ripple effect moves up the supply chain like a wave, from the dealer to the refinery to the mine. At each step, the credit contraction squeezes the flow of metal tighter and tighter. This is the capital crisis that the title of this video references. It is not a crisis of metal supply in the traditional sense. There is silver in the ground, there are mines operating, there are refineries with the capacity to produce. The crisis is a crisis of capital, of liquidity, of the financial plumbing that allows the physical market to function. The banks have decided to turn off the tap, and without that tap, the market cannot clear. Demand cannot meet supply. Price cannot do its job of rationing scarce resources. Instead, we get dysfunction. We get premiums. We get shortages. We get a two-tiered market where the paper price says one thing and the physical price says something completely different. We are already seeing this divergence accelerate. The spot price of silver this morning is $77.32, but try to buy a silver eagle for that price. You cannot. The cheapest silver eagle available right now is $86. That is an 11% premium over spot for a product that historically traded at 3 to 4% over spot. The gap between paper and physical is widening by the day, and the credit freeze is the mechanism that is forcing that gap open. Now let us talk about who benefits from this crisis and who is orchestrating it, because this is not an accident. This is not a random confluence of market forces. This is a coordinated action by the banking cartel to protect their short positions and their fiat currency franchise. Follow the money. Who are the largest short sellers of silver on the COMEX? The Bullion banks, JP Morgan, HSBC, Scotia, and their peers. These are the same institutions that provided, the credit lines to the bullion dealers. These are the same institutions that are now pulling those credit lines. Do you see the conflict of interest? The banks are simultaneously betting against silver going up and controlling the financial infrastructure that determines whether silver can flow to the market. It is like a casino owner who bets against the house and then locks the doors so no one can cash out. They are rigging the game at every level. By cutting credit to the dealers, the banks accomplish multiple objectives. First, they reduce the flow of physical silver to the retail market. This might seem counterintuitive. Would not less supply mean higher prices, which would hurt their short positions? In the short term, yes, but the banks are playing a longer game. By restricting physical availability, they are trying to break the psychology of the retail buyer. They want you to go to your favorite dealer website, see sold-out signs and $10 premiums, and give up in frustration. They want you to say, "This is too hard, this is too expensive, I will just buy the ETF instead." And what is the ETF? It is paper silver. It is a derivative controlled by the same banks. When you buy SLV, you are not draining their vaults, you are not demanding delivery, you are playing in their sandbox with their rules. The credit freeze is designed to herd retail demand away from physical metal and into paper products that the banks can control. And here is where the mathematics become truly frightening. The credit freeze creates a feedback loop. When dealers cannot buy inventory, they raise premiums. When premiums rise, the all-in cost of silver increases. When the cost increases, the dollar value of each transaction increases. When the dollar value increases, the dealers need more credit to fulfill the same number of ounces. But they have less credit, so they can fulfill even fewer ounces. So premiums rise further. So the dollar value increases further, so they need even more credit. Do you see the spiral? The credit freeze does not just cause a one-time shortage. It causes a cascading series of shortages that accelerate with each cycle. We are on week 1 of this spiral. By week 4, the retail market could be completely dysfunctional. Now let us talk about what this means for the COMEX and the paper silver market. Because the credit freeze is not just affecting retail dealers, it is affecting the entire delivery mechanism of the futures exchange. When a contract holder stands for delivery on the COMEX, they are demanding physical metal. That metal has to come from the registered vaults. But the registered vaults are already at historic lows. The banks have been bleeding inventory for months. Now, the entities that would normally replenish those vaults, the refineries, the recyclers, the mining companies, are facing their own credit constraints. They cannot finance the movement of metal into the COMEX system. The vaults are not being refilled. The outflows continue while the inflows dry up. This is a recipe for a delivery failure. If enough contract holders stand for delivery and the vaults cannot fulfill those demands, the COMEX will have to declare force majeure. They will settle contracts in cash at a price determined by the exchange. And the moment that happens, the credibility of the paper silver market evaporates. No one will trust a futures contract that can be cash settled at the whim of the exchange. The paper market will die. And all of the price discovery will shift to the physical market, where the dealers are already operating under a credit freeze. The timing of this credit freeze is not coincidental. Look at the calendar. We are entering the last week of the month. This is when the delivery notices for the current contract month are finalized. This is when the metal is supposed to move from seller to buyer. By cutting credit now, the banks are ensuring that the physical market cannot absorb any overflow from the futures market. If contract holders cannot get delivery from the COMEX and they try to source metal from the retail market, they will find the retail market frozen. The banks have locked all the exits. They are trapping the longs in a paper cage. But the longs are not stupid. They see what is happening. They are going to stand for delivery anyway, just to force the issue. They are going to call the bluff. And when the bluff is called, when the COMEX cannot deliver and the dealers cannot supply, the price of silver will gap up in a way that we have never seen before. Second, by cutting credit to the dealers, the banks are preserving their own capital for the margin calls that they know are coming. Remember, the banks are short hundreds of millions of ounces of silver. Every dollar that silver rises costs them billions. They need cash, lots of it, to meet their margin requirements. Where does that cash come from? It comes from their credit facilities. Every dollar they extend to a bullion dealer is a dollar they cannot use to post margin. So they are pulling back on lending to preserve their own ammunition. They are cannibalizing their commercial banking relationships to feed their proprietary trading desk. This is the sign of a desperate institution. A healthy bank grows its lending book. A dying bank shrinks its lending book to hoard cash. The credit freeze is evidence that the banks are in survival mode. They are circling the wagons. They are preparing for a siege. And the siege engine is the rising price of silver. Third, and this is the most insidious objective, by cutting credit to the dealers, the banks are creating a narrative. They want the mainstream financial media to report that there is a silver shortage, but they want the cause of that shortage to be attributed to retail mania, to speculation, to irresponsible investors chasing a bubble. They do not want the cause to be attributed to the banks themselves. They do not want you to know that the shortage is artificial. They do not want you to know that they manufactured it by denying credit to the supply chain. When the history of this period is written, they want to be the victims, the responsible adults who tried to manage a crisis caused by the Reddit crowd and the YouTube influencers. They are setting up the narrative for the congressional hearings that will come later. And they are doing it by strangling the very dealers who serve the retail community. Do not let them control the narrative. The credit freeze is not a natural market phenomenon. It is an act of economic sabotage. It is the banks using their control of the financial system to punish anyone who dares to challenge their monopoly on money. The dealers are collateral damage in a war between sound money and fiat money. And right now, the fiat money cartel is deploying every weapon in its arsenal to delay the inevitable. But here's the catch. Here is the fatal flaw in their strategy. They can restrict credit. They can raise premiums. They can create temporary shortages. But they cannot print silver. They cannot conjure physical metal out of thin air. The fundamentals have not changed. The mining supply is still in deficit. The industrial demand is still accelerating. The solar panels still need silver. The electric vehicles still need silver. The AI data centers still need silver. The military still needs silver. No amount of financial engineering can alter the physical reality that there is not enough silver to meet demand at current prices. The credit freeze is a delaying tactic. It is a finger in the dike. It might hold back the flood for a week, for a month, for a quarter. But the water is still rising on the other side. And when the dike breaks, when the dealers finally exhaust their remaining credit and cannot source metal at any price, the physical market will completely disconnect from the paper market. We will see a bifurcation that makes the current 11% premium look quaint. We will see physical silver trading at 50, 60, 100% premiums over spot. We will see the spot price become irrelevant, a fiction that exists only on trading screens, while the real price is discovered in the back rooms of coin shops and the private sales between investors. This bifurcation is already beginning. Let me give you a specific example. Yesterday, a contact of mine who operates a regional coin shop in the Midwest received a call from one of his longtime customers. This customer is a retired engineer who has been stacking silver for 15 years. He wanted to sell 200 ounces of silver eagles. My contact quoted him a price of $78 per ounce, which was spot plus a small premium for the recognizable product. The customer laughed. He said, "I know what the dealers are selling eagles for. I want $85 per ounce, or I am not selling." My contact thought about it, checked his inventory, checked his wait list, and agreed to the deal. He paid $85 per ounce for silver eagles, $8 over spot, to a customer walking in off the street. And within 2 hours, he had resold those same eagles to another customer for $90 per ounce. Think about what that means. The real market, the physical market, is trading at $90 per ounce. The paper market says 77. The divergence is 17% and growing. This is happening in coin shops across the country right now. The paper price is becoming a fiction. The real price is being discovered in the physical market, and the credit freeze is accelerating this divergence by limiting the ability of dealers to arbitrage the gap. Let me run some numbers for you so you understand the scale of this capital crisis. The total retail silver market in the United States moves approximately 150 million ounces per year. At an average price of $75 per ounce, that is $11.25 billion of annual volume. Now, retail sales are not evenly distributed throughout the year. During price spikes and market panics, weekly volume can surge to 10 times the normal rate. In a single week of crisis buying, the retail market might demand $300 million or more of physical silver. If the aggregate credit capacity of the dealer network has been cut by 60%, which is what our sources suggest, then the dealers can only finance $120 million of that demand. The other $180 million of demand goes unfulfilled. Those are the customers who get wait lists. Those are the customers who see sold-out signs. Those are the customers who rage on Reddit about why they cannot buy silver when the price is supposedly going up. This brings me to the most important point of this entire report. The credit freeze is not a problem. It is a solution. It is the market's way of forcing a repricing. It is the mechanism by which the lies of the paper system are exposed and the truth of the physical system is revealed. For decades, the banks have suppressed the price of silver by flooding the market with paper contracts. They sold silver they did not have. They promised delivery they could not make. They created an illusion of abundance to keep the price low. The credit freeze ends that illusion. Without credit, the dealers cannot source metal. Without metal, the shelves go empty. Without supply, the price must rise. This is the free market asserting itself against decades of manipulation. It is painful, it is disruptive, but it is necessary. The old system has to die so that the new system can be born. And the new system will be one where the price of silver reflects its true value, not the value assigned by banks who are short the metal. Let me tell you what I expect to happen in the coming weeks. First, we will see the premiums continue to rise. The dealers who still have credit will use it to acquire as much metal as possible. They will mark up that metal to reflect the scarcity. Premiums of $10, $15, $20 over spot will become normal. Second, we will see the wait times extend. Even if you place an order today, you might not receive your metal for 4, 6, 8 weeks. The supply chain is clogged, the refineries are constrained, the mints are backlogged, patience will be required. Third, we will see some dealers go out of business. The smaller players, those without deep pockets or banking relationships, will not survive the credit freeze. They will run out of inventory and run out of cash. The consolidation of the dealer industry will accelerate. Fourth, we will see the paper price become increasingly disconnected from the physical price. The spot price will continue to be set by the futures market, but that price will bear no resemblance to the price at which physical metal actually trades. The divergence will become so extreme that the mainstream media will be forced to acknowledge it. Fifth, and most importantly, we will see the beginning of a systemic crisis in the precious metals market. The COMEX will face delivery challenges. The LBMA will face supply constraints. The ETFs will face redemption pressures. The entire infrastructure of the paper-silver market will be tested to the breaking point. This is not a prediction. This is a description of a process that is already underway. The credit freeze is the catalyst. The reaction has started. The explosion is coming, and there is nothing that the banks can do to stop it. They can delay. They can obfuscate. They can manipulate, but they cannot create silver where none exists. They cannot fulfill deliveries with paper promises. They are trapped by the very system they created. The leverage that gave them power is now their prison. The paper that made them rich is now their poison. This is the ultimate vindication for everyone who has stacked silver through the years of ridicule and suppression. You were not crazy. You were not early. You were right. The system is breaking exactly as we predicted it would. The credit freeze is the crack in the dam. The flood is coming. Let me give you a historical parallel so you understand what we are facing. In 1979 and 1980, during the Hunt brothers silver squeeze, the exchanges changed the rules mid-game. They went to liquidation-only trading. They prohibited new long positions. They allowed the price to be suppressed by fiat. But even with all of those interventions, silver still reached $50 per ounce, which in inflation-adjusted terms is over $150 today. The current situation is more severe than 1980 by every measurable metric. The short positions are larger. The physical deficit is larger. The industrial demand is larger. The geopolitical tensions are larger. And now we have a credit freeze that did not exist in 1980. The banks are more desperate. The situation is more unstable, and the eventual resolution will be more explosive. What does this mean for you, the individual investor? First, it means that if you have been waiting to buy physical silver, your window is closing. The credit freeze is going to accelerate. Premiums are going to rise. Availability is going to shrink. The buy button is going to disappear. If you can find silver at a reasonable premium right now, buy it. Do not wait for a dip. The dip in paper price will not be accompanied by a dip in physical price. The days of cheap silver are over. Second, it means that if you are holding paper silver, whether in an ETF, a futures contract, or an unallocated account, you need to seriously consider converting to physical. The paper market is on the verge of a credibility collapse. When the delivery failures start, when the cash settlements are forced, the paper holders are going to be left holding worthless claims on metal that does not exist. The only silver that counts is the silver you can hold in your hand. Third, it means that you need to prepare for a period of extreme volatility and uncertainty. The credit freeze is a sign that the system is breaking. When systems break, they do not do so in an orderly fashion. There will be gaps up. There will be gaps down. There will be manipulation. There will be counter-manipulation. There will be news events that seem designed to shake you out of your position. Hold the line. The fundamentals are on your side. The mathematics are on your side. The physics are on your side. You cannot print silver. You cannot decree it into existence. The shortage is real. The credit freeze is proof that the banks know it is real. Their desperation is your confirmation. Now let us talk about the contagion risk. The credit freeze in the silver market is not happening in isolation. It is a symptom of a broader credit contraction that is sweeping through the global financial system. The banks are not just pulling credit from bullion dealers, they are pulling credit from everyone. Commercial real estate loans are being called. Business lines of credit are being reduced. Mortgage approvals are being tightened. The entire economy is being squeezed. This is what happens when a debt-based monetary system reaches its mathematical limit. The debts are too large. The interest payments are too high. The collateral is too impaired. The banks have to shrink their balance sheets or they will become insolvent. The credit freeze in silver is just the tip of the iceberg. Below the surface, a massive deleveraging event is taking place. And when deleveraging happens, when credit contracts and debts are called, the only assets that survive are those without counterparty risk. Real assets, hard assets, physical assets, gold, silver, land, commodities. The credit freeze is a signal that the smart money is already rotating into these assets. The smart money knows what is coming. They are getting out of the paper system before the paper burns. So what should you do right now? If you have physical silver, hold it. Do not sell it for fiat currency that is being printed into oblivion. Do not sell it for paper promises that will be broken. Hold the metal. It is your insurance policy against the collapse of the credit system. If you do not have physical silver, acquire it as quickly as you can. Pay the premium. Wait for the shipping. Do whatever it takes to get metal in your hands before the window closes completely. If you have a relationship with a local coin shop, use it. Local dealers often have credit arrangements with regional banks that are more stable than the national dealers. They might have inventory when the big dealers are sold out. If you have wealth in paper assets, consider reallocating a portion to physical precious metals. This is not financial advice. I'm not telling you to sell your stocks or your bonds, but I'm telling you that the credit freeze is a warning sign. The system is more fragile than it appears. Diversification into real assets is prudent. And finally, share this information. The mainstream media is not going to tell you about the credit freeze. They are not going to explain how the banks are strangling the silver supply chain. They are not going to connect the dots between the credit contraction and the physical shortage. That job falls to us. We are the signal in the noise. We are the truth in the lies. We are the community that watches, that analyzes, that shares. Every person you inform is another node in the network. Every viewer you bring to this channel is another soldier in the battle for sound money. The banks have the credit. They have the media. They have the regulators. But we have the numbers. We have the truth. And we have the silver. The credit freeze is their last desperate gambit. It is the final attempt to delay the inevitable. But it will not work. The demand is too strong. The supply is too weak. The mathematics are too clear. Silver is going to reprice. And those who hold physical metal when that repricing occurs will be the beneficiaries of the greatest wealth transfer in modern history. This has been Silver Storm Daily. The liquidity freeze is here. The capital crisis is real. The dealers are maxed out. The banks are desperate. And the price of silver is about to reflect that reality. Remember to like, subscribe, and share this video with everyone you know who needs to hear the truth. The storm is upon us, but for those who prepared, the storm is not a disaster. It is an opportunity. See you in the next report.